Okay, well, thank you all very much for coming this evening. We might make a start because we changed the room. I think we might have a couple more people trickling in the next few minutes. I'm Miranda Stewart, for those who don't know me. I'm a Professor and Director of Tax Studies here at the Law School at the University of Melbourne. I am really delighted that we are hosting Dr. Eric Toder, who's one of the directors of the Tax Policy Centre, the Urban Brookings Tax Policy Centre in Washington, D.C. in the US. Most grateful for the Melbourne School of Government funding Eric's visit out here for the week. We're working him very hard. He's already given one seminar at the Faculty of Economics at the university, and he's involved in an event with us tomorrow as well, thinking about tax reform, as well as this lecture tonight on directions in US corporate and international tax reform. So Eric is an Institute fellow at the Urban Institute, which is a long-established, well-regarded, independent policy think tank. That might be the right approach, although to me it's more of a policy and research institute, not just a think tank based in Washington, D.C. The Tax Policy Centre is an initiative of both the Urban Institute and the Brookings Institution, of course, also a very well-known policy research institute in DC. So neither of them are academic bodies, but they play a very large and well-respected non-partisan role in US policy debates, and the Tax Policy Centre over the last decade in the US has I think played an increasing role and has a high media profile, non-partisan media profile, I would have to say, in that quite complex tax reform environment in the US. So Dr. Toder himself, long-standing expertise in tax, previously was in the US Treasury Department, a Deputy Assistant Secretary for Tax Analysis, also Director of Research at the US Internal Revenue Service, and has also been at another important institution in tax policy in the US, the Congressional Budget Office, Deputy Assistant Director for Tax Analysis there. He has actually been in our part of the world a few times, though I think he's never acted as a consultant in Australia, but he did spend some time, around about 2 years, I think, in New Zealand, advising the New Zealand Treasury, so has some familiarity with tax policy processes down under. Originally received his PhD in economics from the University of Rochester, so a very long experience both inside and outside government in tax analysis and policy discussion. And to me, he's one of those few highly technically expert tax people with technical expertise in tax analysis who can convey those issues and concepts to a broader public audience for these really important policy debates. So Eric will be talking to us tonight about US corporate and international tax reform. We came up with the title of Principles and Reality, possibly to reflect the gap between what might be the appropriate principles and what actually is the reality on the ground, but we might hear a bit more about that from Eric. And I do think it is very interesting and timely for us to look again at the situation in the US. Obviously, there's a lot of Australia-US trade and investment. The US-Australia Tax Treaty, a very important document in international tax planning. And we watch the developments, in particular with US multinational enterprises, very closely in terms of the planning and negotiation they are doing with the US Treasury and the implications in Australia. So I think that learning some more about that and the difficult issue of how to tax corporate income in a globalised economy, something that we really can benefit from. It's particularly timely given that we've just had the release by Treasury of the corporate tax scoping paper on base erosion in the corporate tax in Australia. I do think Australia isn't differently situated, but that might be something that we could talk about with questions and discussion after Eric's talk. So Eric has said that he's very happy to have questions, for example, about law or confirming facts or uncertainty during his talk, but there will be time at the end of the session for broader questions and discussion, and so I would really encourage you. I'm very pleased to see there's a lot of experts in the room, actually, so I think that we might be able to have some interesting discussion. Sorry for that long introduction, but I thought it appropriate to set the scene, so I'll hand over to Eric now.
Well, Miranda, thank you for that very kind introduction, and I want to thank you for inviting me here. It's always a pleasure to come to Australia, and I've enjoyed the week so far a great deal, and I'm looking forward to the rest of the stay. I do want to acknowledge that the title of this talk is perhaps a little bit misleading, although it's nice to talk about principles versus reality. It's misleading in the sense that what we seem to be doing in the United States these days doesn't really have much to do with principles, and often the discussion doesn't have much relation to reality either. So nonetheless, I hope I will at least touch on some of these questions as I go through this. I also want to note that I did see the Treasury study. I can't say I've absorbed all of it, but the key message to me seemed to be the difficulty that single countries have, any single country, in taxing entities like corporations, which are now becoming totally globalized, and the need for international cooperation if we're going to have anything left of a corporate tax in 10 or 20 or 30 years. I think that's very well recognized in Australia, and Miranda referred to the differences between Australia and the United States. Obviously, we're a lot larger, have much more influence in the world, but I think the reality that we also, in order to sustain our system, will need to rely on some kind of international cooperation is something that we're not as aware of as we should be. So we can certainly learn from that perspective. I think being a smaller country gives you a better appreciation of the extent to which we're an open, globalized economy than we sometimes do, although we're getting there. So let me just outline what I'm going to talk about, and it's going to be highly oriented toward what we're doing in the U.S. I hope you see some parallels or some things of interest to you. First, I want to talk a little bit about the overall budget political framework. What's the environment in the U.S. at this time as we're considering corporate tax reform? I'll give a little bit of background on the U.S. Corporate income tax system. Then I'll talk about the canonical reform in the U.S. was in 1986. I know you guys had reforms in the 1980s. New Zealand did, UK. There was tax reform movement across the world. People in the United States always referred to the 1986 reform as the gold standard of tax reform, but raising the question of is it possible to do today what we did in 1986? And I think you can probably gather from the way I framed the question that I think the answer to that is no, and that we need to think in somewhat different terms today, that the same mantra or system is not totally replicable. We have a lot of discussion in the United States. We are one of the few countries that still has a worldwide system, and there's a lot of talk about moving to a territorial system, so I'll spend some time talking about that choice, understanding, of course, that there's no such thing as either a pure worldwide or a territorial system, and so it's really a question of what form of hybrid you want to choose. And finally, given there are a lot of ideas on the table, I just want to raise the question of whether we should be thinking more broadly and more fundamentally about how to change our system of taxing corporate and business income beyond the kinds of things that we usually talk about. So I'll just throw out a few kind of off-the-wall ideas at the end. Okay, so starting with the U.S., our overall budget picture. We've been hit very hard by the global financial crisis. I gather you've avoided a good part of the impact. Maybe you had a better banking system than we do. we were hit pretty hard. We had a very deep recession, the deepest we've had since the Great Depression. I think through some smart policy on the basis of our Reserve Bank and also a stimulus program, we managed to avoid slipping into a Great Depression. But nonetheless, our economy has been performing well below capacity, and that's led to very high budget deficits in the past few years. The budget deficit situation has improved greatly in the past year. It's projected to improve more. So in the short run, it looks like we're solving our problem. Of course, we're not. The biggest drivers of the long-run budget deficit are not the economic recession, but the aging of the population and the growth in healthcare costs. Those are inevitable. They're happening throughout the world, or throughout at least the advanced countries. Certainly, I'm sure that's happening here as well, and that's going to drive up the share of debt to GDP. Even by the end of the decade, that's going to start rising, and once you push out beyond the 2020s, it's really going to be very bad. Now, part of what's driving our problem, the population aging causes some increase in healthcare costs because older people use more health services, and of course it raises the cost of our government-funded retirement programs. The retirement hit is about 1.5 to 2% of GDP. It's large, but it's certainly manageable, and people have designed a lot of ways on paper you could meet that situation. The healthcare issue is a lot harder to meet. On the other hand, we don't really know how serious it is. Healthcare cost growth has dropped a lot in the United States in the last year or two, and what we don't know is whether that's a permanent development or just a temporary blip. So there's a huge amount of uncertainty surrounding healthcare costs, which really is the one element that's really driving the long-term budget out of control. But I think our best guess is our long-run fiscal system is out of balance, that ultimately we're going to need some combination of reduced spending on health and retirement programs and increased revenues. And it's very hard to see how we could do it without doing both. So that raises the issue for the tax system. Is our tax system up to raising more revenues, or do we need tax reform? Or at least that's one of the drivers for thinking of tax reform, that our current system may not be up to the task of raising more money. Without going into a deep explanation of the U.S. political system, I would point out, obviously, we have a presidential system, not a parliamentary system. And for anything to get done, and two houses of Congress, things have to get through the lower house, the upper house, and be signed by the president. The president has put forward his budget. It's, as usual, a detailed blueprint of the policies he's proposing. The House and the Senate have not passed budgets per se. They've passed budget resolutions, which are really outlines of what they plan to do, but they haven't filled in the detail. The other aspect is our politics have gotten very polarized. The Republican Party now has the majority in the House of Representatives. The Democrats have the White House and the Senate. So some kind of negotiation needs to take place in order to get something done, and it's hard to see how that's going to happen. They're quite far apart. The House has proposed in their budget resolution to cut the individual tax rate. The top individual rate is now 39.6%. They would cut that to 25%. They would cut the top corporate rate from 35% to 25%. They would eliminate the individual alternative minimum tax, but they would raise the same amount of money that's projected in the congressional budget forecast, a little over 19% of GDP. We've estimated that their proposals that they've mentioned would lose $5.7 trillion in revenue over 10 years, which means they would have to close a lot of tax preferences to make that up. They've not mentioned a single one they would eliminate. So we will see what that happens. The Senate is a little more ambitious. They want to raise money. They're not proposing to reduce tax rates. They're raising $950 billion over 10 years through eliminating preferences. they also have not said which preferences they would eliminate. The president is more specific, and I'll get to that in the next slide. He would raise about $880 billion over 10 years through some tax expenditure reductions and through some tax increases. That, by the way, over 10 years represents about 0.5% of GDP. So actually, despite all the noise, in terms of how much is being raised as a percentage of GDP, what the Republicans and the Democrats are promising is not that different. Finally, it's worth noting that the House and the Senate tax writing committees, that both chairmen have been talking to each other, have been working together, and have been doing extensive hearings and study on the possibility of tax reform. Both of them, Max Baucus, who is the Senate head of Senate Finance and is retiring at the end of next year. Dave Camp, who is a Republican chairman of the Ways and Means Committee, is not retiring, but he is term limited as chairman. So they are both coming to the end of their role as head of the tax writing committees, and they are very eager to do tax reform and have actually been going around the country talking about it and studying it. What they do remains to be seen. So let me go through this in a little more detail. The president would raise $880 billion in over 10 years. The main proposals, he would put a 28% cap on the value of tax expenditures. That is, if you take a deduction now when you're in a tax bracket higher than 28.6%, every dollar by which you reduce taxable income is equal to your marginal tax rate times that amount of the exemption or deduction. So somebody in the 39.6% bracket, instead of getting a benefit of 39.6% of the preference, would only get to claim a tax saving of 28% of the preference. So this is really cutting back the value of many tax preferences: mortgage interest, state and local tax, charitable deductions, health care exclusions, tax-exempt interest. All of those things would be reduced or shaved for the highest income proposal, and that would raise about $530 billion over 10 years. There's also proposal to change the formula used to index inflation in going forward. Our tax system is the brackets and the exemptions and so forth are indexed for changes in the consumer price index. They are proposing a new and more accurate way of measuring the consumer price index, which would lead to smaller adjustments, and that would raise $100 billion. It would also cut the growth in Social Security benefits. That's extremely controversial, especially within the president's own party. He would increase the tobacco tax. He would raise the estate tax somewhat, and there are a bunch of other proposals. The president has also proposed a reserve, it's not part of his official budget, to fund corporate tax rate cuts. That he's talked a lot about revenue-neutral corporate tax reform. In the past has said he would like to reduce the top corporate rate from 35 to 28%. However, when you look at all these proposals, they include some reforms of international tax, some changes in accounting rules, cutting oil and gas tax preferences, a few other little things. They would raise $335 billion, but he's also proposing about $250 billion of new tax incentives, making permanent the research credit, some new subsidies for renewable energy, some new benefits for advanced domestic manufacturing, and all those would lose about $250 billion. So when you look at the net gain from his proposals, they turn out to represent about under 2% of baseline corporate tax receipts, which means, by my way of doing math, that he would only be able to reduce the corporate tax rate to slightly over 33% if he did all the things he proposed. So this reserve doesn't really get you very far in terms of cutting the corporate tax rate. Why is reform unlikely this year? Well, major disagreements between the parties, how much revenue to raise, and how to change the distribution of the tax burden. The Democrats want to raise more revenue from high-income people. The the Republicans don't want to raise more revenue and would like to cut taxes on high-income people. They don't come out and say that. And there are substantial obstacles to corporate tax reform. One is among the Democrats and the liberal groups, labor groups. There's a lot of resentment in a time of budget austerity to cut corporate taxes, so they're opposed to that. There's not a lot of potential tax expenditures to fund lower rates, and as I will discuss later, there are big conflicts within the business sector. Although the business sector would like lower taxes, the idea of tax reform, lowering rates and broadening the base affects different businesses in a very different way, and so there is really no consensus within the business community of what they would like to do on tax reform, other than the fact they would like to do it. So that's another obstacle. So let me turn from that sort of general summary of where we are to a discussion a little bit about of the U.S. Corporate tax. What does our corporate tax system look like? This will be a very quick 5-minute tour of the U.S. corporate tax system, and I'll talk about three things: what's happening with receipts, what's happening with the shift in the composition of business activity, which is a very important issue when you discuss taxation of businesses in the United States, and how our regime or how our rules compare to other countries. So first, trends in corporate tax receipts. There was a golden age back in the 50s when the corporate tax was really important. It accounted for over a quarter of the tax receipts in the U.S. It was roughly almost 5% of gross domestic product. Over a long period of time, that importance of the corporate tax in our revenue system has eroded. Partly that had to do with increased changes in the business landscape, reduction in corporate profits as a percentage of GDP over a period of time, shifting of activity overseas, more debt finance, shift to non-corporate businesses, and also changes in the tax law, reduction in corporate tax rates, increases in more generous capital cost recovery provisions, and so forth. And that was going on for a long time, for over 30 years. But if you look at the last 4 decades, and I go through the end of this decade based on the projections of receipts by the Congressional Budget Office, the corporate taxes as a percentage of GDP are very stable. They're roughly around. They move around a lot from year to year. They drop during recessions. They've gone down in some years because of temporary tax benefits, such as expensing of investment, which has been in effect at times. Then, of course, when the expensing it goes away, if it's temporary, in future years, companies have less capital recovery deductions because they've already done it, so revenues go back up. And so we have a lot of bouncing around from year to year, but pretty stable trend of around 2% of GDP for the last 30, 40, for the last 30 years and 10 years going forward. So our corporate tax receipts really are not declining, at least as far as we know. Now, that's not to say we might not have a problem with the corporate tax collections, maybe given the rise in profits of U.S. multinationals, the shift in the distribution of income, the shift in income shares between capital and labor. Maybe they should be going up, but in any event, they are not going down, and our corporate tax, at least according to current projections, is not disappearing. You might note, I've seen the data for Australia, that we raise a lot less as a percentage of GDP than Australia does. I don't know, and we raise less than the OECD does. I'm not sure of all of those reasons, but I will hint at a few of them. And one of the big reasons we don't raise that much as a percentage of GDP is what's going on with flow-through businesses. And I don't have complete data on this, but some of if you look at the top line of this chart, that's corporate receipts as a percentage of GDP in 5-year periods. As I said, it's roughly stable, but it's bounced around a bit. The next is taxes on profits of flow-through. This comes from the Tax Policy Center's simulation model. We only have data for that going back to 2004, so that's why I've only got those years, and then we're projecting to 2022. But as you can see, there is an increase in the revenue that's gotten. Now, the way we do this is we assume that supposing there was no income from sole proprietorships, from partnerships, from limited liability corporations, which are limited liability companies, which are limited liability partnerships, and from what we call subchapter S corporations, which under our subchapter S are corporations that are taxed as flow-throughs. That is, they don't pay corporate tax, but their income goes to their individual owners, and the owners pay tax on those profits. So we're really looking at what would happen if, in these calculations, what would happen if all those profits were zero relative to what happens given what they are, and this amount of revenue is the difference between, what happens when you add back what they've actually got and compare it to if they gotten zero. So these are all individual income taxes that are paid from these flow-through businesses. And you can see that that's been projected to rise over time. You could see that also that the corporate share of receipts, tax receipts from businesses, has been falling from about 2/3 in 2004 to 2008 to only a little over half of revenues in 2019 to 2022. Another way of looking at this is to look at the taxable profits. There is data going back further from this, not projections, that are published by the Internal Revenue Service. And you look at this data, this is showing the profits of C corporations, that is corporations under our subchapter C, which are subject to the corporate income tax, and taxes of other businesses that are not subject to corporate income tax, the profits of those businesses. And you could see a really striking change. In the beginning of the 80s, the C corporations accounted for over 3/4 of business profits, and now they account for less than half of business profits. So, and I would assume, given the trends in our data and the projections, that figure is going to be going down in the next 10 years. So when you look at business in the U.S., most of it's not corporate. But the corporations are dominating multinational businesses, and that's kind of a key point or fact. In comparison to other countries, the United States has now the highest corporate tax rate in the OECD. That calculation is not based on just the federal rate, but on the subnational rates, which average 6.3% as state corporate income tax rates. When you add the two together, since the state taxes are deductible, the total tax is 39.3%. We used to be second to Japan. Since Japan's lowered its top rate, we're now the highest in the OECD. But if you look at how much we tax new investments, which is looking at what's the tax that you would pay on a hypothetical investment, or what's the difference between the pre-tax and the after-tax return when you take into account capital recovery provisions, credits, and so forth, our effective tax rate is, because we have somewhat more preferences than some other countries, is about the same as the average of the G7. It's still higher than most of the OECD. So we're still high in terms of effective tax rates, but arguably not so far out of line. And the effective tax rate is really what is the measure of the incentive to make a new investment in the U.S. relative to somewhere else. But nonetheless, the statutory tax rate is very important for companies. It does particularly suggest what is the benefit that you get from locating income in the U.S. relative to somewhere else, and clearly it's advantageous if you can do it to locate your profits in another country, even in another developed country, leaving aside tax havens, which I'll get to in a minute. But with this high rate, we raise less corporate revenues as a share of GDP than other countries in the G7. And as I said, I think part of that reason has to do with preferential treatment. Part of it has to do with the amount of our business that comes in flow-through form rather than in corporate form. The final kind of stylized fact that U.S. Business leaders always point to is the fact that most other countries exempt foreign source dividends or repatriated dividends from tax, or have so-called territorial systems. And over time, of course, the number of countries with territorial systems has increased, the two biggest changes in recent years being the UK and Japan. France and Germany have had territorial for a long time. Canada is an odd case. It's inching toward territorial because it has territorial with respect to its treaty partners, and that treaty network has been expanding over the last 30 years. So that is argued by our corporate leaders, places U.S. multinationals at a competitive disadvantage relative to other multinationals who can repatriate their dividends tax-free. Other important differences between our tax system and others, we raise less revenue as a share of GDP than the OECD average. I think we might raise a little bit more than Australia. Australia is also on the low end of the OECD, but you know, we're pretty far down on that. So even though Americans complain about taxes a lot, we're a low tax country. We're also the only major economy without a value-added tax or other form of national consumption tax. We do have retail sales taxes at the state levels, and most of our states have retail sales taxes. But when you look at state plus federal, our sales taxes are a much lower percentage of revenue in the U.S. than they are just about everywhere else. Of course, the VAT and the corporate tax bases differ in two very significant ways. One is the VAT has effectively expensing instead of depreciation, so it's a consumption-based tax instead of an income tax. And the other is that the VAT is destination-based rather than origin-based, so you don't have the issue in a VAT as to where the income originates, where the production originates. You don't have the transfer pricing issues of the VAT that you do with the corporate tax. So those are two reasons why in some ways a VAT is a better base, although it has other problems. Okay, so that's kind of, you know, I can stop and see if there are any clarifying questions at this point. That's kind of our very brief summary of what our tax system looks like. Okay, so I'll move on to the question is, can we repeat 1986? And so obviously, I need to say what we did in 1986 to raise the question of whether we can repeat it. So in 1986, at the corporate level, we lowered the top corporate rate from 46 to 34%. At that point in time, the United States had after 1986, had one of the lowest top corporate tax rates in the world among the developed countries. In any event, we've since raised it to 35, so it's pretty close. And other countries have lowered their rates. So by standing in place, we now have the highest rate. So we really haven't raised it, but it's just gotten higher because everyone else has dropped it. The 86 reform eliminated many business preferences, eliminated the investment credit, made accelerated depreciation much less generous, particularly for housing and other structures. And overall, because of changes, and also had much more restrictive capitalization rules. So as a result of all of these changes, the 86 Tax Reform Act actually raised corporate revenues, and those corporate revenue increases were used to help fund individual income tax cuts. In fact, what's likely now, if we have tax reform, would be the reverse. We would end up with individual income tax increases or something else funding or cuts in corporate revenues. So that's one thing that's very different. The 86 reform also did the same thing on the individual level, lowering the individual rate and raising the corporate rate. By the way, in terms of this movement to flow-throughs, the 86 Act and things that followed had a lot to do with that movement to flow-throughs. The one thing after 86, before 86, the individual rate, top individual rate was higher than the top corporate rate. After 86, the corporate rate was higher than the individual rate. And so that made it advantageous for many small businesses who were using corporations as a tax shelter previously, companies that had discretion over how much dividends they paid out, now could just, were actually better off being organized as flow-throughs because the individual rate was lower. We also relaxed our rules on qualifications to be an S corporation. We started introducing limited partnerships, and so many more enterprises were formed. So you didn't need to be a corporation to have the advantages of limited liability. And so we facilitated, both gave more incentives for those kinds of organizations and facilitated their development. The other thing we did was check the box, which in the domestic rule world made it easier to just decide whether you wanted to be a partnership or a corporation without going through a lot of legal hoops. That came in fact in 1997. Check the box had some less desirable consequences on the international scene, which I will get to. What Obama and Camp have proposed to reduce the corporate rate, again, to broaden the base to maintain revenue, but without saying how they would do it. Obama has some specific proposals, but not enough to get to the 28%. They intend to be revenue neutral, or the corporate reform. The corporate reform is being discussed separately, at least on Obama's side, from individual reform, as if you could do that. And finally, the House Ways and Means Committee has endorsed a territorial tax. The president has not, and that's a big difference. So why is this not make sense to do corporate-only reform? There are really three reasons why this kind of 86 style, lower the base, broaden the base doesn't work. For one thing, base broadening creates a lot of problems. It spills over outside the corporate sector. So if you lower the corporate tax rate and broaden the tax base, you're basically going to be raising revenues from all flow-through businesses, including all small businesses, because they don't benefit from the corporate rate reduction, but they would be hit by the reduction in preferences for depreciation and other items. So politically, it's almost a non-starter to say we're going to cut taxes on multinational corporations in a revenue-neutral way in order to raise taxes on small, quote, small businesses. Not all those businesses are that small, but many of them are. There's also an issue in coordinating the individual and corporate rates. If you reduce the corporate rate without reducing the individual rate, you create a big incentive, actually the reverse incentive for what you have now, for corporations to become tax shelters. So you have to have all kinds of rules. My one-time tax policy colleague, Daniel Halpern, who's a professor at Harvard Law School, has wrote a very nice paper for us on how you would deal with a different lower individual and a corporate tax rate, and what kinds of things you would have to do to prevent the tax avoidance that would result from that. You know, one thing you could do is actually mandate that businesses below a certain size that are closely held be taxed as flow-throughs, so they would not be allowed to undertake C corporation status. That would probably be unpopular, but that's a way of doing that. And finally, I think partly as a thought experiment, there's this funny notion of thinking of corporations as separately from individuals. You know, all of us know, however, that all taxes are ultimately paid by individuals, that corporations are just entities, and that the corporate tax is somehow paid either by shareholders or by other investors, or perhaps it flows through the workers. And in particular, you really need to look at the division of the corporate tax burden between the corporate and shareholder levels. And so you really ought to think more holistically, how are you taxing the income that arises in a corporation, and should you be taxing it at the corporate level, or should you be taxing it at the individual shareholder level, or rather, how much should you be taxing at each level? And these proposals don't really address that issue. Finally, I think there's not enough money from the corporate tax expenditures to fund this rate reduction when you look at them closely, and that's why it's not surprising that Obama was not able to get there in his budget. And so here's kind of an example of what the corporate tax expenditures are. And I've got 3 bars here. One, the corporate revenue loss. This comes from year-old Treasury figures. The individual revenue loss and the total revenue loss. The individual revenue loss is the revenue loss through flow-throughs. And you could see right away the biggest item in this is accelerated depreciation of machinery and equipment, which is a preference for investing in machinery. There's a question, though, of whether, A, we're really serious about getting rid of that when the president himself has proposed bonus depreciation in his recent budgets. And also, if we want to increase incentives to invest in the United States, cutting back on depreciation is not the right way to do it. Now, one might say, well, so what? We really want a neutral tax. We don't want to favor machinery and equipment over structures or over inventories or over other business investments. It's good to have a neutral tax. But then it's not clear that that gets us toward a neutral tax either. And I think that has to do with some very good point that was mentioned in the Treasury report, in which we've been saying over and over again, that the really dynamic growth businesses in our country and throughout the world are not the heavy industrial businesses with large amounts of capital equipment anymore. They're the high-tech firms, the drug firms, the companies that are really investing in intellectual capital. And of course, the development of intellectual capital is already subject to expensing. It's already all of that R&D and all of that intangible capital and the increase in value of companies that start up like Apple and Facebook when they discover something interesting, all of that is effectively expensed. So to talk about cutting the depreciation preference, yes, it gets you neutrality with respect to structures, but it takes you farther away from neutrality with respect to all the companies that are relying heavily on intellectual capital. So it's not necessarily making the capital-intensive manufacturing neutral with respect to other activities. You could argue that you probably should be giving them some preference to be more neutral across the board. Low-income housing credit is a big item. Might want to get rid of that, but that's really a social program. The second one is the deferral of income of CFCs. That's a tax expenditure because the way we do the tax expenditure budgeting, we assume a worldwide tax on the income of resident multinationals as kind of our baseline system against which we measure tax preferences. It turns out, of course, that a worldwide tax of that type, in which you have a current taxation of all income of U.S. multinationals, is a system which no other country in the world has, and would really most likely would put our companies at a big disadvantage. And nobody in the reform agenda is really talking about doing that. In fact, people are talking about moving in the other direction and moving toward a territorial system. So when you look at sort of another one is expensing of R&D. I don't think anybody's really talking seriously about that. So when you look at the big preferences, most of them are really off bounds in terms of the discussion, or at least questionable about whether they make sense to tackle. I'm going to skip that. Here are some calculations I made of how much you could get the rate down if you eliminated all business tax expenditures in a revenue-neutral way. First, I started off by saying, suppose you eliminate all tax expenditures. You could get it under 25%. That sounds, pretty good. This is a very, very rough calculation. It's not accurate. It's probably exaggerated because you don't actually necessarily, from eliminating a tax expenditure, recapture the full amount of that tax expenditure. If you took away all the tax expenditures except international, you could get to 26. If you took away everything except accelerated depreciation and R&E expensing, you could get down to 31.5. If you dealt with only the narrowly targeted preferences that help particular narrow industries, you could get to 33.1. And Obama's budget proposals, this is a year-old number, 33.5. I guess I would now say 33.2. So the answer is you can't get very much from tax expenditures. Are there other ways of financing a lower corporate rate? Well, here are some other ideas that could be done, but it takes you into sort of somewhat more difficult territory. One way is base broadening other than tax expenditures. Now, there are some ways you can broaden the base by reducing deductions or by that are not listed in the tax expenditure budget. For example, you could limit the deductibility of interest income. There have been proposals out there to do that. I think the problem with limiting the deduction, first of all, in terms of if you want a neutral tax, that's not neutral. Interest is a cost of doing business, so generally should be deductible. You could argue that maybe if there are some preferences, you shouldn't be able to deduct the interest against that. The other problem is, in a global sense, limiting interest deductibility, given the highly elastic nature of flows of lending across the world, is probably, even to the United States, is likely to raise the net cost of borrowing and raise the net cost of capital in the United States in a way that other measures that we might undertake would not do. So that's problematic, but a lot of people have talked about that as a potential. Do you have a question or no? Okay. The other proposal that people have thrown about is, suppose we take all the large flow-throughs that have developed and subject them to the corporate income tax. So they would, in effect, be subject to two levels of tax, just like corporations are, where they're taxed on their profits and then taxed again on their distributions. I guess the trouble with that method, or the thing that troubles me about it, is that actually, if you looked at how you want to tax business income, flow-throughs are actually the right way to do it. That you really want to tax income to the individuals receiving the income at those individuals' appropriate tax rate, that's what produces neutrality and fairness. And so if we were thinking of an ideal tax, we would probably want to tax all business enterprises as flow-throughs. For practical reasons, we don't do that, but why, when we have business enterprises that are taxed the way we think business should be taxed, do we want to go away from that? Just in the interest of raising more money. So those are at least problematic, but those are certainly ways which could raise a good deal of money and could help push the rate down. Yeah.
Just in terms of the flow-throughs.
Yeah.
There's a lot of investment obviously that occurs from pension funds, and here there's a lot of money in superannuation. Where the flow-through at the moment is going to a pension fund that's presumably tax exempt, not paying any tax. In those circumstances, isn't there a distortion in the sense that you've got pension funds that are able to compete in the marketplace against corporations on a more favourable basis because they don't have that tax cost associated with whatever the business activity is that they're investing in. And so doesn't the flow through cause a problem there? And wouldn't a possibility, do you see a possibility that governments in trying to raise extra revenue might take away some of these tax concessions that pension funds or super funds in Australia have at the moment in terms of the way they're taxed?
Okay, so I guess I'd make two comments and we could discuss this later. One thing is, I guess maybe this is the way I look at the pensions. It's basically the pensions are allowing certain individuals to get a zero marginal tax rate on their investment income. So it's kind of part of the rate schedule, that the pensions are not necessarily driving down the cost of capital, because the marginal investor is somebody who's paying at a full rate, but they are getting a higher after-tax return for those individual investors. And that's kind of a policy choice to allow people to accrue retirement savings tax-free. Now, the question is, should that be limited? Are we allowing too many people to accrue, and people with too high an income level to accrue too much retirement income tax-free? I think the answer is yes to that. And I think we should be restricting that. But that doesn't really have to do with the flow-through versus corporations. It refers to whether we should be giving that much of a preference within the individual income tax rate to certain savers. So that's just, we can have a conversation a little more. Yeah.
Sorry, just a question or a comment on the flow-through as the theoretical ideal.
Right.
I think that's right when you're looking at, say, a closed economy. But I think where you sort of, particularly if you're a small open economy like Australia, then you sort of get into questions of jurisdiction. Because if the flowing through, at least as the way I understand it, the tax is essentially occurring at the investor level. And so if that investor is a foreign investor, then that potentially means that you're not you're losing the taxing rights in relation to that investor.
Right. Yeah, I think in our context, most of the flow-through businesses are domestic. So that's, and the multinationals, which are the big publicly traded firms, are corporations. But I think your point is well taken. One very important reason to raise is to maintain a corporate income tax is the rent, the sort of rent that you pick up from foreign investors through the corporate income tax. And now, whether in a small open economy you're actually picking up that rent or not, or it's being passed through, in terms of higher capital costs, that's questionable. I think certainly we're getting some rent from it. So that is one strong argument for us to maintain some kind of a corporate tax, and one weakness of one of the crazy ideas I'm going to discuss at the end of the talk. That's a good point. So a second way of doing this is something that was actually, I think, in the spirit of what Henry was recommending a few years ago when he wanted to get rid of franking, and also in a spirit of a proposal, an idea that I, with a couple of colleagues, Roseanne Altschuler and Ben Harris, wrote a paper at the Tax Policy Center a few years ago. And our idea is, why not fund a lower corporate tax rate by raising taxes on shareholders? The U.S. has gone toward eliminating the double tax, but not, we were arguing, in the right way. We were doing it by reducing the top tax rate on dividends and capital gains in the 2000s under the President Bush administration to 15%. The top rate on ordinary income being 35 at the time, so it was a very substantial preference for dividends and corporate capital gains. Dividends up to then had been taxed as ordinary income. And our argument was the corporate tax is mostly a tax on investment that's sourced in the United States, so it does have a distortive effect in terms of affecting the desirability to invest domestically as opposed to somewhere else. But the individual taxes are taxes on dividends which people receive from anywhere in the world, and so they don't really affect the location of investment flows or the capital gains tax. So why are we giving a preference to dividends and capital gains, which in our view was just flowing through as higher after-tax income to shareholders and not having a significant effect on the cost of capital? So our argument of the economics of, gee, it really made sense. Supposing we were just to go back to the rates that used to be in effect at the end of the Clinton administration and raise the capital gains rate to 28% and raise and tax dividends as ordinary income, how much corporate tax reduction could we get? And it turned out we calculated we could get the corporate tax rate down to 28%, coincidentally. So that was one way we could have financed that. I thought it was a great idea, and apparently the United States Congress thought some of it was a great idea because they now have let the capital gains and dividends rates go back up, the top rates, to 20%. And then they've added on, as part of the Health Reform Act to help pay for it, an additional 3.8% surcharge on investment income. So the top rates are now 23.8% instead of 15%. However, they haven't used that revenue to lower the corporate tax. So we can't get much mileage out of that anymore like we could have before. They took the part of they took some of the revenue that we were earmarking for corporate tax reduction, use it for something else. So that, but nonetheless, I thought that was, one way of looking at that problem, that you probably ought to be taxing in a globalized economy more at the shareholder rather than at the corporate level. Then there are a possibility of new tax sources. A value-added tax could pay for some corporate reduction. Obviously, you have to deal with the issue that the value-added tax is regressive. You have income distribution problems. You have to compensate somewhere else in the system for that. So that's only part of the solution. And carbon tax has the same distribution issues, but at least has the benefit that you're doing something to deal with the serious problem of global climate change. I very much admire Australia for having taken the lead in this, although I'm not sure how much impact Australia has, but it's setting a good example. I wish that the U.S. were doing something of that nature. I think that would be extraordinarily helpful. But there is, unfortunately, not much political. This is one of the ideas in which policy wonks of the right and left tend to agree that a carbon tax is a good idea. But politicians, particularly in the Republican Party, it's poison, and they're actually claiming that climate change is not occurring. So we don't need this. My colleague Donald Marin and I had a paper recently in which we explored how much you might be able to reduce the corporate tax rate by combining corporate reduction with some corporate base broadening plus a carbon tax. And again, you could get the rate down to something in the high 20s by doing that. And we explored some of the ways you might offset some of the distributional impacts by giving credits to households or payroll tax credits. So, but that is clearly another way of thinking about it. And our thought was this could sort of buy the corporate sector into a coalition with the environmentalists, where both might support a carbon tax in exchange for lower corporate rate. Another way of thinking about trade-offs. So let me, probably talking too long about this, I want to get to the, I'm just about done, right? And I haven't even talked about international tax. Oh, well. All right, so let's, what? That makes things easy for me. So let me just say, I'll go through these quickly. The concern about international tax in the U.S. is we have a high corporate effective tax rate, which discourages investments. We tax foreign source income, which gives a competitive advantage to foreign-based MNCs. Our repatriation tax keeps trillions of dollars now funds taxed overseas. So those are the things the companies complain about. Everybody else looks at all this income shifting is going on and all this tax that Apple and Google and all these other companies are at Starbucks are avoiding. And So they worry about this erosion of the corporate tax, and they also worry that the preferential treatment of foreign source income may be encouraging U.S. companies to shift jobs overseas. So almost nobody is happy with the current situation. So people talk a lot about competitiveness, but the problem is there are different things we're competing for. If we want to attract workers, we want a low individual income tax. If we want to attract capital, we want a low effective marginal tax rate, including capital recovery rules on domestic investments. If we want to increase the corporate tax base, we want a low, have income shifting to the U.S., we want a low statutory rate. And if we want to make U.S. Multinationals more competitive, we want a low U.S. tax on foreign source income. And we can't do all those things at the same time. So that makes it hard. So what is a territorial tax? I guess you know that. You would impose no tax on foreign source income. But nobody really has that. Countries have eliminated taxes on repatriated dividends, but they all impose, including us, impose some restrictions on the exemption of foreign source income, whether they be controlled foreign corporation rules, thin cap rules, the way transfer pricing is enforced, in order to prevent base erosions. So when people talk about territorial, they're very mindful of that, including the Republican representative camp, that you don't want to have a system which makes the problem of income shifting by Apple and Google even worse. It's obviously on the face of it going to be worse if they can not only shift park their profits overseas, but then bring them back home tax-free. And so you've got to have something else that goes with that. So the issues are, if you go territorial, first of all, what can you do to tighten allocation rules for profits? How can you restrict the location of investments that might qualify for either exemption or deferral? What should you do about income from intangible property? There were some papers out there that said if you had full taxation of royalty income and treated that as domestic income, you might actually raise revenue from going territorial, because today that royalty income a lot of it is sheltered by foreign tax credits, or at least has been. What limits should be placed on foreign tax credits in the new system? And finally, a big one, what transition rules should you apply to all these profits that have been accrued under the previous rules? You certainly don't want to let all those old profits be brought back tax-free. And so what should you do about that? So one proposal is the one by Camp, and that is still not a fully formulated proposal. He would allow a deduction of 95% of all foreign source dividends from which is essentially like exemption from a controlled foreign corporation. Our subpart F rules are code; those are our CFC rules. He would use those to tax some income, continue to use those to tax passive income, which is not repatriated. He'd have a transition tax on all offshore profits, new thin cap rules, and then there are three options that would be used to prevent base erosion. A tax on excess foreign profits, which is one that's similar to something that the president has proposed. A version of the low effective tax rate test used in Japan. That's basically saying countries that have a low effective tax rate, you would tax those profits on a current basis, that is on an accrual basis, not on a deferral basis. Or another way of just having a tax rate for all foreign intangible income of 15%, and again, that would also be on accrual basis. So and you would include them in subpart F if the foreign rate were lower than 13.5%. So you'd basically be imposing an accrual tax on those profits that are being, or intangible profits that are coming from Ireland or the Cayman Islands or somewhere of that nature. I guess the ultimate problem with all of this is, how do you have an international tax regime in a world in which companies are truly global? You can't really define the residence of a corporation very well. Corporate residence is very elastic. Companies can shift or start up as residents in some other locations, or companies resident in one location purely by the fact that they're tax resident could have an advantage over very similar companies with a different tax residence. So how do you have a worldwide residence system working? How do you have a source tax when with intangible income there's no really good way to tell where the source of that income is? The intangible profits really are a public good which it can be used by any sub of the company wherever in the world they're producing. And so you don't really have a very good basis with all of this tinkering, and the territorial proposals may improve things somewhat. It's basically saying today we have a hybrid system in which we allow deferral but have a full tax on repatriation. What we would be doing is getting rid of the tax on repatriation, but in exchange cutting the benefits of deferral, so we have some partial accrual tax on foreign source income. And maybe that's a better hybrid than what we've got now if you think the repatriation tax is very distorting of behavior. But it's got to be, in my view, only marginally better. Doesn't deal with the fundamental issues. So the question is, should we think broader about corporate income tax? And I just throw out a few things. The reason we want to tax corporations in the first place is to keep people from accruing income tax-free in corporations. Flow-through treatment would be desirable if feasible. So here were some other ideas. One was due to Alan Auerbach. He's written this up as a destination-based cash flow tax. This would allow expensing of businesses to expense capital investments, would have a deduction for exports and a tax on all imports. So he would get rid of the transfer pricing problem and get rid of the non-neutrality between physical investments and other investments, but keep essentially a tax on the profits that are due to economic rent. I've asked Alan, well, what's the difference between that and a VAT? And he's pointed out to me, as somebody else suggested, by maintaining the corporate tax, you're able to get taxes on the foreign shareholder investments that you wouldn't be able to get under a VAT. The disadvantage of Alan's system, I think, aside from the fact that it's a little unfamiliar, is it's not clear how this would stand up under WTO trading rules to allow a destination-based tax that looks like an income tax, even though it effectively really is a consumption tax. Second off-the-box idea is a partnership treatment of all income, that is taxing individuals on a residence basis. The partnership treatment, flow-through treatment, was always viewed as infeasible because it's so complicated to allocate the income of publicly traded organizations. But maybe I'm told it's feasible with today's technology. The drawback, which was one questioner raised of that, is what do you do when you're giving up the corporate tax about the foreign shareholders? So that's certainly, but I think it's certainly an idea worth exploring. A third way is to get rid of the corporate tax entirely and instead have a mark-to-market tax on the value of corporate shares for publicly traded corporations. So you would just have an accrual capital gains tax to replace the corporate tax. That's really a way out idea. Again, has some of the same problems, but it does solve the issue of you want to tax your residents on their worldwide income. That's a way of doing it, and it solves the Apple Google problems that we've kind of been dealing with without adversely affecting your company's competitiveness. A fourth is formula apportionment of income. Of course, that would require a lot more international coordination than it is now, which brings us to the last slide, and I guess I just have questions. Why it is needed, I think, seems obvious, given the difficulty of a single country enforcing a tax on multinationals. Is it achievable? I don't know the answer to that. I think it's very hard. I think it's very hard in America to get people to think in those terms, but I think ultimately that's the way we need to go. So I'm going to stop and I'll leave questions at this stage.